Welcome back. Today we're going to talk about mortgage spreads. A mortgage spread is a comparison of the 30-year average mortgage rates versus a 10-year U.S. Treasury. Now, mortgage rates we know typically follow federal funds and other fixed income markets. So when interest rates go up, mortgage rates go up, and conversely they go down. But it's not a locked one-on-one relationship. The mortgage spread, the average of the 30-year mortgages may tend to rise away from the 10-year U.S. Treasury bond, and sometimes they'll contract. Now, there's a lot of different components that go into the mortgage spreads, but generally speaking, when mortgage spreads rise, meaning the difference between the 30-year average mortgage rates and the 10-year U.S. Treasury, when that difference increases, that usually coincides with recessions or the times prior to recessions. Now, taking a look at the following chart, the blue line represents the average 30-year mortgage right now. The red line represents U.S. Treasury. Now, of course, the 30-year mortgages are always going to be above the 10-year U.S. Treasury. The black histogram bars show us the spread. Again, the black histogram bars show us the difference between the blue line, the 30-year mortgages, and the 10-year U.S. Treasury, the red line. Notice that when the blue line is further away from the red line, the black histogram bars tend to rise. When they're closer together, they tend to contract. Now, currently we see 30-year U.S. mortgage rates are approximately, 6.5%, give or take. 10-year U.S. Treasury, about half that. So we have the mortgage spread is around about 3% right now. That's the difference between the 30-year U.S. Treasury and the mortgage spreads. Here's a closer look at the same picture. Again, blue line represents 30-year mortgages as they stand right now. The red line represents U.S. 10-year Treasury bonds. The yellow histogram bars show us the mortgage spread. So notice as the red line, the 10-year U.S. Treasury went down, the blue line stayed pretty constant, and the difference between the two increased. It widened, and that's why these yellow histogram bars rose. Now, it's very interesting to see why this is happening. Lately, we've seen, and we talked about in a prior video when we were talking about the history of the inverted bond markets, we can see that U.S. Treasury rates, the interest rates, are collapsing, especially on the 1 year, but really across the board. The 1 year and the 10-year over the past 30 days has been down about 14%. So the yields are going down. But why is the 30-year mortgage rate not going down? Well, the 30-year mortgage rate has an extra component built in, risk. And that if it's thought by many economists that if we're on the brink of a recession or if we're staying in uncharted or uncertain economic times, well, it's more risky for a bank to give a lender a loan to buy a house. So they're going to add a little bit of extra risk to that 30-year mortgage. That's why the mortgages aren't coming down while 10-year U.S. Treasuries are. And that's why the mortgage spread's increasing. And again, notice right now we're right around a 3%, 3.04% for the mortgage spreads. That is pretty historic. Take a look at the red line, that's the S&P 500. The blue line are the mortgage spreads. Inverse correlation. This goes back to 2013. Notice how the S&P 500 goes up. The mortgage spreads, the blue line, stay low. This is the crash of 2020. S&P 500 came down. The mortgage spreads increase. Again, generally speaking, when the stock market goes down, mortgage spreads increase because it reflects an increased amount of risk inside the fixed income market. Then we saw a tremendous rally, and through 2021, stock market goes up higher, mortgage spreads decrease. That's because no matter what was happening, whether the bond yields were going up or down, the difference between the treasuries and the mortgages decreased. Now we see stock markets wavering and mortgage spreads are once again rising to the upside. Now, take a look at, these are the actual figures. These represent the average mortgage spreads per month and per year. So the numbers across the top, the 1 through 12 represents the months, January through December, and then we have an average of the entire year. And then we have this broken down by year. The green squares over here show us the relatively low mortgage spreads. Notice in 2014, 1.64% average. 2015, 1.71%. By the way, going back many, many years, the overall average mortgage spread is around 1.7%. So when you see numbers below 1.7%, it means we're under the average, which means the stock market is, generally speaking, outperforming its average because stocks go up and mortgage spreads go down. But conversely, notice 2020, the average mortgage spread was 2.23%. Of course, March, April, and May represent the highest points. That was that COVID stock market crash. 2021, we had a nice recovery with the stock market. The average mortgage spread dropped to 151. Last year, 2022, the average mortgage spread was 2.35%. And we can see it increased October, November, December. We were at the 288, 295, 273 levels. Well, now we look 2023. We're currently, in the month of March, so far, an average mortgage spread of 2.93%. In fact, the overall average for the year so far is 2.72%. Again, the average mortgage spread over many decades is 1.7%, around 170 basis points. So this is a pretty significant extended overbought, or I don't want to say overbought because we don't know how far this will go up. But there's a lot of risk built into the mortgage spreads right now. We're very much above the average. And then finally, we see here the white line is the S&P 500. The blue histogram bars show us the rate of change in 1 month. How much mortgage spreads have changed? And you'll notice when mortgage spreads accelerate higher, that coincides with weak stock markets. Notice in 2020, mortgage spreads in 30 days went up 46%. The average 30-year mortgage, the difference between that and the 10-year U.S. Treasury exploded 46% for good reason in the year 2020. We can see more recently, we had a very big stock market correction going back to June of last year, 2022. The mortgage spreads in 30 days, this is June, July of last year, went up 38%. Well, even more recently now, we see an explosion, 39% increase in mortgage spreads on March 15th, going back 30 days, 30 calendar days. So we can see that while the stock market seems to be weak lately, it doesn't have a tremendous trend, but there is a weak tone to it. The bond market is really telling us something. It's telling us that while interest rates are coming down, the 10-year bond yield and the 1-year bond yield are going down, mortgage rates are staying high, and that difference between the two is widening, and it's something that's actually quite unusual. Now, this is, of course, not 100% predictor of what's to come, but I think it's very important to make note of how the fixed income market is behaving, because with the fixed income market, the economists like to say that the fixed income market reflects more macroeconomic conditions, where the stock market, the S&P 500, reflects the anticipation of corporate earnings. Sometimes there's a disconnect between the two. So it's important to look at multi-markets and many different markets to try to get the best read on the current situation. We're going to continue to track mortgage spreads really closely, and we'll be sure to update you along the way. We hope this has been helpful. We look forward to seeing you back soon.